Hi everyone. Today's video, as you have already seen, is about fair value gaps. If you are one of those traders who are trying to actually understand fair value gaps and you are trying to actually know on how you can use the fair value gaps, this video is going to actually explain deeply about fair value gaps. And I believe if you watch this video to the end of it, you're going to actually learn very well about the fair value gaps. And so we should start first by actually trying to understand what exactly is a fair value gap and how we can use it. So fair value gaps occurs when price action shows a price imbalance or inefficiency. So in another word, fair value gaps can also be called the imbalance or inefficiency. So there are different words, but they mean the same thing. So fair value gaps can also be called imbalance, can also be called inefficiency. It typically occurs when price action moves fast in one direction. So you may experience an aggressive move in one direction, either in buying or an aggressive move in selling. Okay. So it means when we talk about aggressive move, it means we just see a single type of candles moving in that just one direction. Okay. So if we are in an uptrend, we will see a bunch of bullish candles being formed. Okay. And if we are in a bearish move, then we will experience bearish candles, consecutive bearish candles being created, and they tend to have large bodies and a very small wicks. Okay. So this kind of movements, which are aggressive moves, they tend to leave a little or sometimes no trading activity. When I talk about not trading activity, here we're talking about the buying and selling. Okay, as you know, when we talk about trading, we are talking about the availability of buyers and sellers in the market. So if we are experiencing an aggressive move, it means you will just see single type of participant in the market. It may either be buyers only if we are bullish, and if we are selling, or if we're in a bearish market, then we just experience single type of participant, which are just sellers. Okay, so which means we may have total full single candles, or sometimes we may have a very small number of the opposite candles. Okay, which means there won't be any kind of buying and selling in that movement. There will just be a single type of movement. You'll just see either a bullish move or a bearish move, which will be completely full of the single type of candles. Okay, and also sometimes you may not even see liquidity areas, okay, at certain price level. So it means you will see just a single movement in the same direction, which will not give you any kind of retracements. Okay, so it means even areas where you can mark your liquidity points, it won't be easy for you to mark it. So which means at that kind of leg, we have an aggressive buying or an aggressive selling. Okay, so also the gap can also hide the key levels from retail traders. Okay, so if you have no understanding of fair value gaps, then it won't be easy for you to actually mark the key levels, because most of people, you will find that they tend to use the order blocks or demand and supply zone or support and resistance levels in marking the key levels. Okay, but if you are someone who also have the understanding of fair value gaps, then it's going to be very easy for you to actually see the key levels, just like the way the big banks are actually showing the signs or the footprints. Okay, so fair value gaps show institutional movements, which are just like institutional footprints. Okay, so it gives you an indication that at that particular area where you have that aggressive buying or aggressive selling, it is a sign of these institutional traders, or what you can call these big banks or the big institutions or the smart money are actually moving. Okay, so if you see very aggressive move, it means that area there was a large amount of actually orders being created by either big banks, the smart money, or the big institutions. Okay, so it is very good for you to know the fair value gaps. Okay, because if you know how to mark your fair value gap areas and how to spot those aggressive areas or the big momentum movements, then it's going to be easy for you to actually know, like, okay, this area is where I can see big institutional movements, which gives you a sign that the market can actually return back into that original initial area, and then you can actually look for your entries. Okay, because the market tends to actually feel imbalances before continuation. Okay, so it means that there will reach a time where price will have to go back and revisit that area where they left the fair value gap. Okay, so if you already know how to mark the fair value gaps, it means it's going to be easy for you to actually know how to wait for price and how to execute. So knowing the importance of how fair value gaps are supposed to be played will increase your success massively. So if you already know the importance of fair value gaps and you know how to use them, then it's going to be actually a game changer for you. And also fair value gaps can be called displacements or imbalances. It is just different terms. Okay. So always look for untested fair value gaps rather than the fair value gaps that have already been mitigated. Okay, these untested fair value gaps are going to become more powerful, especially with key liquidity behind them. So you see the secret here, which means before you have marked your fair value gap and before you wait for price uh, to return back into that untested fair value gaps, make sure there is already key liquidity. Okay, or it can be liquidity sweep, or it can be a turtle soup has already been formed before price created that aggressive move or formed that fair value gap. Okay, and the touched fair value gaps or the mitigated fair value gaps become less valid as they have already been tested. So you know, like the more the test, the less valid that fair value gaps becomes. And here you need to know that the touched fair value gaps or the mitigated fair value gaps, they tend to become inducement levels. Okay, understand that. So if you see any fair value gap which has already been mitigated, then expect if price goes back into that level, it means price is going to sweep that level. It becomes an inducement level now. So it becomes less valid. And you need to know this. Make sure you only wait for price to mitigate the untested fair value gaps. And it has to be an area where there is already liquidity sweep or turtle soup has already been formed before formation of that fair value gap. That's going to be your more valid fair value gap. And also, fair value gap should never be used by itself. Don't use that just fair value gap by its own on its own. Make sure you actually incorporate or add another confirmation and another confirmation entry point. So for example, you may have a fair value gaps, but it already overlaps with either a breaker block or it may be overlapping with the order block. Okay, things like that. Okay, so it has to be a fair value gap that is not just by itself, because the fair value gap is useless if there is no liquidity behind it. So first, there has to be liquidity sweep before formation of that fair value gap. But also at that area where you have your fair value gap is more and more advised if there is another PDRA or point of interest that overlaps with that fair value gap. So if a significant fair value gap has no liquidity behind it, price action will ignore it. Therefore, price action will chase the next level above or below it. So understand that concept. So you need to actually make sure that your fair value gap has to be the one that has a liquidity before formation of it, and also there has to be an overlapping PD array or an overlapping point of interest that will give you more strength for that fair value gap to hold the price. Okay, so because most people are actually getting confused, like how can I mark the most valid fair value gap, because sometimes there is more than two fair value gaps. How can I know if this one is going to be the one? And how can I risk my trades? How can I use my risk management plan in this kind of area? But what you need to know is make sure you just use the fair value gap that has already been there has already been a liquidity sweep behind it before formation of it. And also it's more important if there is another overlapping point of interest. It can be an order block, it can be a breaker block, or it can be a mitigation block, or it can be a reclaimed order block. So it depends with the type of entry that you most of the time you like to use. Okay, so this is an example of how we mark this fair value gap. So you can see these consecutive bullish candles. Okay, you can see also these consecutive bearish candles here. They show you the aggressive move, aggressive buying. Okay, here we have aggressive buying, and here we have aggressive selling. Okay, so they show you like the price is showing aggressive moves, which are signs of institutional movements or institutional footprints. So you can see how we mark them. We mark from we always tend to use 3 consecutive candles. Okay, 3 consecutive candles in order for us to know if we are going to if we have a fair value gap or not. Remember, it doesn't need to be just the same type of candles. I mean, sometimes you may see a single bearish candle with 2 bullish candles, or it may be a single bullish candle with 2 bearish candles. It depends with the strength of that movement. That's why I've said you will see price either leaving a little trading opportunity or no trading activity, which means if there is a little, it means there may be some few opposite candles in that movement that created a fair value gap. So here I have just used this similar candles. Okay, for example, in this bullish move, you can see we have the bullish candles, and for a movement that goes higher, we always have to mark from the high of the first candle, and also you mark on the low of the third candle, and the second candle is going to be the one that's going to determine if there is any gap. And if there is a gap like here, which now this becomes your fair value gap. Okay, because price is not showing any like the first candle here and the third candle are not touching each other. There is a gap here, which means now this is your fair value gap, or an imbalance, or an inefficiency, or a displacement area. Okay, again, when we're in a bearish move or we are looking for sales, you can see we mark from the low of the first candle and on the high of the third candle. And if you have the gap like here, this becomes your fair value gap. Okay, very nice. So you can see simply how we mark the fair value gap. So let's check the examples from the charts on how we can mark fair value gaps and how we can use them. So remember what I just said about how we mark fair value gap. First, we need to check if there is a liquidity behind it. So if you look closely here, you see price had this movement to the downside, then a movement to the upside, another a simple move to the downside, and then a move to the upside, and then we had this aggressive move to the downside. This aggressive move is the one that created fair value gap. Okay, so you can see here we had this liquidity sweep there. We had a liquidity sweep. Okay, this is liquidity sweep. Okay, the buy side liquidity sweep there. And after we had that buy side liquidity sweep, you can see formation of these 2 fair value gaps. Okay, so we had 2 fair value gaps. The first one was this one here, the lower one, this one. Also, we had this one. 2 fair value gaps close to each other. Now you may ask yourself, which one am I going to use as my entry point? The most important thing is to remember the concept that I have already explained. Okay, I've already explained that the most important fair value gaps is the one that we actually first will have a liquidity behind it. As you can see, we already saw the liquidity, the buy side liquidity at this area here. Okay, I showed you that there was liquidity sweep. And next thing is if there is any overlapping point of interest. Overlapping is that fair value gap. So if you look on this, the first one, this one does not have any overlapping point of interest, but this one here has it, and it is in a premium level. Okay, so let me show you, so you can see this one here. Okay, this is what this is the breaker block. So we have a breaker block there, overlapping with this fair value gap there, and entry is on the 50% of what, of this fair value gap, which is what we call the consequent encroachment. Okay, so 50% of a fair value gap is what we call a consequent encroachment, CE. Okay, consequent encroachment. So here we have this consequent encroachment. Okay, the CE, the consequent encroachment, and this is going to be your entry point. And you can see the price tap into this here, 50% of this fair value gap, and dropped to the downside, targeting this next drawn liquidity, the sell side liquidity level. Okay, so you see this breaker here is the one that was used as our supporting PDRA or as an overlapping PDRA. And if you are still confused with what exactly is a breaker block, I have already created a video about breaker block, so you can check it. It's a very simple concept. Okay, so this is the one that gave more strength to this fair value gap there. Okay, so that's the first example of how we can use fair value gap. The second example is on the long position. Here you can see what happened is price created this turtle soup here. Okay, after we had that turtle soup, you see price went higher, creating this break of structure, and this movement here is the one that left behind a fair value gap. Okay, look closely at this level, you will see. If you look closely here, you see this was our first candle, the high of the first candle, and the low of the third candle there. And this is the 50% of our fair value gap, 50% of the fair value gap, which is what we call the consequent encroachment. And this is where we take our entry. Okay, and you can see at the same area here, that's where we are having the same thing, what we call breaker block. This blue candle there, that's our breaker block. Okay, that's our breaker block. This one here, this is our breaker block, the blue candle here. This is the breaker block, and this is going to be the supporting PDRA that's going to give more strength to this fair value gap to hold the price. And our entry is going to depend on this fair value gap, especially on the 50% of the fair value gap. And you can see price tap into the 50% of the fair value gap, and we had an aggressive push to the upside. Okay, and this was Aussie dollar. Okay, on 30 minutes time frame. So remember, sorry, this is not a short position, this is a long position. And you can see here we had this simple fair value gap. Okay, it's not going to be an easy one, because this is not going to be the strong one that you're going to just use. This is going to act as one of the PDRA that's going to act as a key level. Okay, it's going to be a key level and not an entry point. Okay, it's going to be a key level which is going to actually help price to go higher. And you can see we had this break of structure there, and this is a major break of structure. But remember, inside this movement here, we had this market structure shift there. Okay, market structure shift leaving behind this, and we had this fair value gap there. And if you look again, there was this supporting PDRA, which was this IFVG, the inverted fair value gap. Okay, inverted fair value gap. This area here, there was an inverted fair value gap, which may also act as a balanced price range, the BPR level. But to keep it simple, this is just the inverted fair value gap. Okay, I mean this one, this fair value gap, which was first disrespected. Price didn't respect it, Instead broke it and went higher, but created another fair value gap there. And now this becomes an overlapping PDRA, a supporting PDRA, a supporting point of interest. That's going to give more strength for this fair value gap to hold the price. That's why you see after this tap into this fair value gap, price went higher aggressively, tapped into this drawn liquidity, which was the major breakout structure. But also before that, we had formation of another fair value gap there. And clearly this is a very simple one again, because we have this mitigation block. Okay, that's a mitigation block, or it may act as your supporting point of interest. That's going to give this fair value gap strength to hold the price. And you can see the 50% of the fair value gap is going to be our entry point, and this was a very good trade. Okay, this just to show you how fair value gaps can actually act as a very good point for reversal. Okay, don't always get stuck with order blocks or with supply and demand zone. Okay, fair value gaps are one of the most powerful entry levels also. Okay, and you can see another example here is price on this, on gold, 30 minutes time frame. Very good example of buy side liquidity here. And after liquidity sweep, what happened is market showed this market structure shift there, leaving behind this fair value gap. Okay, and this fair value gap is overlapping with this big order block. Okay, so have an order block there overlapping with this fair value gap, giving this fair value gap more strength to hold the price. And if you have no strength, you have no confirmation, if you need more confirmation, remember we have this reclaimed order block, this level here, that's going to act as a reclaimed order block. If you remember, and if you have watched the video about the reclaimed order block, you know this level here. You're going to use that as a reclaimed order block, okay? And it is going to act as another confirmation or supporting PDRA that's going to give price more strength, okay? So it's very simple there. I believe you see how easy it is, okay? And entry is on this 50% of the fair value gap, okay? Pushing price lower, you target this, or you may target 1 to 2 or 1 to 3, depending on your risk management plan, okay? So that's another example of how fair value gaps work and how fair value gaps can actually become strong levels for reversals, okay? Remember, fair value gaps are very strong. Don't just get used to these order blocks and support and resistance, or just supply and demand. Also, fair value gaps are very strong. You can see price revisited this fair value gap there, 50% as your entry level, okay? And this as your supporting PDRA. What is this? This is the inverted fair value gap, okay? A fair value gap was first disrespected, but then price revisited it, and it becomes a very strong very strong supporting PDRA. If you still have no confirmation about this, you still need more confirmation, look at this area here. You have the reclaimed order block, okay? Reclaimed order block, this one is going to act as your supporting PDRA. Another reason to give this fair value gap strength to hold the price and push price higher. And you can see we went higher and higher and higher. Very nice way of using fair value gaps. And again, we had this fair value gap there being supported with this breaker there, more confirmation, safe trade, okay? So that's another example of how to use fair value gaps. Another one is here. You can see first we had this liquidity sweep there, the inducement, price created an inducement there. That was an inducement here before price tapped into the order block. And after that, what happened was simply market structure shift, okay? Simply market structure shift. And after market structure shift, we had this formation of this fair value gap, okay? This fair value gap becomes what? Becomes our point of interest. And then what happened again? We had this order block above this fair value gap. And also we have a very nice movement to the upside, trying to look for the entry here. You can see price even reached into this order block. So what your entry has to be is on this 50% of this fair value gap. And your stop loss has to be above this. This is why you put your stop loss. Stop loss above this high of this. That's why you put your stop loss, targeting either this, or you may target 1 to 2, 1 to 3, depending on your risk management plan. Okay, so that's how simple it is when it comes to using fair value gaps. Okay, another example here is on gold, 30 minutes time frame. Look closely on what happened here. Very nice form of turtle soups here. Okay, other people call CRT. So we have a turtle soup there, and after turtle soup we had another formation of turtle soup there, and then a very nice market structure shift. You can mark that reverse or market structure shift. All this depends on how you want to actually mark it, but the easy way is to mark this as your market structure shift level, and behind it, we just left behind this fair value gap, 50% of that fair value gap as your entry point. And also we have this, we call it a mitigation block, this kind of area, this area. So it means this candle is going to act this one, the white one is going to act as well mitigation block. Okay, just the different, very a little bit different from breaker block. Okay, so this is your mitigation block. It's going to be a support in PDRA, and you can see price tapped into it. Okay, same way with the 50% of the fair value gap, price tapped into 50% of the fair value gap, and that becomes a very valid entry point. The same thing with the fair value gap that was left here, price left again this region here. This can act now as your what? As another example of a mitigation block. This is going to be a mitigation block. Okay, because a breaker block looks like this. Price tapping into this, this is your breaker block, and you're going to take an entry. But what you call a mitigation block is when price fail to take out this low. Instead, we take an entry from this level. Okay, you see the difference. The difference is for a breaker to be formed, the price has to sweep this, has to sweep that. But for mitigation block to be formed, the price has to fail to sweep the low. Okay, that's a simple explanation. Okay, so that was another example. So guys, up to there, I think that's enough for anyone who wants to actually understand fair value gaps. So don't forget to subscribe, don't forget to like, comment, share this video, and I hope this video was actually enjoyable, educational, and good. So see you in another video. Thank you for your time, guys.